Welcome to Investing in Startups. I'm Joe Mager. Our guest this week is Rex Salisbury, founder and general partner of fintech-focused Cambrian Ventures. We talk about how Rex built a big community and following in the fintech world, why fintech startups are on a roll, disruption versus partnership, and how the venture world is evolving. Please enjoy. Rex, thanks for coming on the show.
Hey, it's great to be here. Thanks for having me.
So I thought community would be a good place to start. Feels like the foundation layer of Cambrian. Can you talk listeners through the story of the community you built up over time and how you engage with that today still?
Yeah, I think probably the most important decision I ever made was just moving to the Bay Area. And so I've been building a community for folks in fintech in the Bay Area, although we have remote community stuff too, for over 10 years now. And I think the Bay Area is the best place in the world to build a company. I think it's also one of the best places in the world to go if you want to experience a really open, interesting group of people. I think one of the defining cultural traits of the Bay Area is openness. That openness manifests itself both in people's willingness to explore crazy new ideas, to start new companies, but it also manifests itself in terms of how people actually interact on a one-on-one basis. Like people are very much willing to pay it forward. They're very interested and engaged in going to events. And so I moved here 10 years ago. I think I showed up in San Francisco December 7th, 2014. I've been an investment banker. I had learned a lot, but totally hated it. And the culture of a lot of banking communities, openness is not really the defining cultural characteristics of those communities. But you move to the Bay Area, and I had taught myself to code, quit my job, moved West Coast, and then I joined a direct consumer mortgage company called Syndio with one of the co-founders of SoFi, which was a really interesting company. I mean, that's a great example there is I just started calling people. I was still on the East Coast trying to find interesting things, talking about what I'd done. And I ended up working at a really interesting company that ended up failing, but that's another story. So anyways, 10 years ago, moved here and I'm now working as a software engineer at a fintech company. I'm like, look, I want to talk to other people who are building really, really interesting things. And so 10 years ago, I started a community also called Cambrian. Now I run a fund called Cambrian and we do some community stuff. And that was right around when companies like Blend, Plaid, Stripe, Wealthfront, Credit Karma are starting to scale. So you have all these technologists who are starting to discover how financial services actually worked and being shocked about the lack of technical sophistication or kind of the age of a lot of the infrastructure underlying our key systems. And so I started a community in downtown San Francisco. We started doing monthly events. We had founders from companies like Plaid, Stripe, Wealthfront, Betterment come and talk about what they were building. And that community grew over time to the point where I had 5,000 meetup members in the Bay Area, 20,000 newsletter subscribers doing monthly events, San Francisco, New York, biennial summits, quarterly job fairs. And I was still doing my day job. But by 2019, I realized I was way more passionate about the fintech ecosystem. I was working as a software engineer. I briefly enrolled as a master's in artificial intelligence program. But I was like, look, fintech is the thing that I'm all in on. So I quit my job, went full-time on the community, was going to raise a fund. And then that's when I ended up joining A16Z as their first fintech partner hired externally and then helped grow and scale that practice alongside a bunch of other great folks. But my plan was always to run my own fund and focus on earliest stage of investing. And so that's what I did in 2021 is launch Cambrian Fund 1. And then as maybe you alluded to in your intro, Cambrian Fund 2 was just announced a couple of weeks ago in July of 2025. So and I invest up to $1 million pre-seed, seed, fintech companies generally. But fintech, turns out everything is kind of related to fintech and financial services. So that's defined pretty broadly these days.
How did you find the raise for fund 2? I hear sometimes that 2 can be more challenging than 1 because you're having to point back to fund 1, but obviously it's too early to have any DPI and much to hang your hat on performance.
Yeah, so fund 1 is 3 years into the vintage. So I would say there are kind of 2 truisms or things you hear. One is this has been the worst time ever for emerging managers to raise. The flip side of that is if you are able to raise, it's actually an amazing time to deploy at pre-seed and seed. Because what you'll see is all the headlines about the big funds raising huge amounts of money. You'll also see about the really big series A's and B's. What people don't realize is there are actually fewer funds now deploying at the pre-seed than there were 1 or 2 years ago, or they've slowed down pacing. So if you're there and you're active and you're interested and engaged, you can find amazing founders to back really early on. And the kind of crazy pricing you see later stage is not as much of a thing. And then 2, what you'll often hear people say about fundraising is fund 1 is raised on relationships, 2 is on momentum, and 3 is on data. So fund 1, my relationships, I raised from 20 plus the top founders in fintech, from SoFi, Wealthfront, Betterment, Blend, Plaid, Checkout, True, so a whole bunch of really, really great folks. And then I raised from some fund of funds and more institutional sources. Fund 2 is raised on momentum. So what was the momentum? Well, as you mentioned, we're only 3 years into the 2022 vintage. Vintage, for those who aren't familiar with venture capital lingo, just means the year that you kind of start deploying from your fund. And usually the data doesn't become like super material when you're looking at IRR, or especially things like distributions and DPI, until at least year 6, maybe even longer than that. And so momentum usually looks like having a really high graduation rate. And so I invest primarily the pre-seed, and about 50% of my portfolio companies in less than 2 years have graduated all from pre-seed to seed through Series A. And that's mostly because they're just better talent in the ecosystem, I think, than there's ever been before. There's better infrastructure they're able to build on top of. And so even if you're backing these people who are pre-product and pre-revenue, you can have a high degree of certainty that they're going to move from pre-seed into prototype, product live, customer sold, launch, scale, maybe close an enterprise client or two. I mostly do B2B. I'll also happily do some consumer. And then that's about where they're ready for the Series A. So for me, Fund 1, relationships. Fund 2, momentum, which was just basically finding really great founders early on who built product, scaled revenue, and then found investors who are willing to do their Series A. So that's kind of where I am with Fund 2.
So I'm going to push back on a point. I completely agree with the early part of that. What I want to push back on is that I think you might be selling yourself short on the graduation rate piece, or at least the
That's
drivers.
great, Joe. Anytime you want to say I'm selling myself
No,
short,
well,
I'll do that.
it's true because, the base rate for graduation rates from seed to A is ballpark 15% over the past couple of years. You're rolling around 50. I mean, that's a pretty big delta. And it's not like fintech as a category. If this was an AI fund, you'd be like, well, okay. Like that makes total sense. There's tons of hot money sloshing around. And maybe you just don't want to say, I'm picking well.
It goes back to what I said earlier, which is there is more talent in the ecosystem than there ever has been before. Like if you back up 10 years and you think, so I run a podcast, I interview some of the top founders in fintech. I've interviewed like founders of, again, Wealthfront, Betterment, Credit Karma, also the CEOs of some publicly traded companies like Marqeta and Bill.com, now Bill. I've got one coming up with the Nubank founder. And if you talk to them about what it was like to start the company 10 years ago, I think Ken Lin from Credit Karma is a great example of this, and therefore an example of how the ecosystem has changed. It's like 2009. I think he was a banker before or worked in, I forget his exact role, but he like definitely had not started a fintech company before because the term fintech didn't become popularized until like 2014. So he had just an existential question about like, how do I build a business? Who do I raise money from? Like Ribbit and QED are the two fintech-focused firms, but they really weren't started until a little bit later. And QED even kind of started out as a family office. So it's like, I don't know who to raise from. All the big funds, they don't have dedicated fintech practices. There isn't like a list of investors you can go out to. So you're like, who do I raise money from? Big question. Then you're like, okay, who should my co-founder be? Well, there is no Stripe, Ramp, Brex. Well, like there aren't these people pouring out of these companies who actually understand how to both do technology and financial services. So you're like, I don't know who to raise from. I don't know who I should hire. And then you're like, how do I actually even build this thing? So if you're Ken Lin at Credit Karma, you need access to the bureau data. And it takes them a really, really long time to get access to the data. And then at one point, I think it was TransUnion, could be Equifax, they turn off his access. And he's like, shit, I don't have a business anymore. So he literally spends years trying to put together a team, scrap together the initial capital, get access to like the key systems of record that he needs to run his business. And it takes him like 5 years to raise a Series A. And arguably, the Series A was not the smart money round because they were still like way under monetized. They hadn't figured out any sort of repeatable go to market. It wasn't until they did some television advertising, I think in around 2014, that they figured out a formula to really drive engagement and attachment. And then they scaled and they went from spending zero on television advertising to over $100 million a year later. And they figured out something that worked. So as you asked, like, why do I think there's a higher graduation rate now? It's like, well, think about all those things that were really, really hard for Ken, like in 2009 when he was getting started. If you're a fintech founder now, you've probably worked at 1 or 2 or 3 great companies. Maybe you've even started a company yourself. So you actually understand how this stuff works. Then you're like, well, I need a co-founder. Who should I hire? Well, you've worked at 3 companies. You have this like network. You go on LinkedIn. You're like, I know 1,000 people who work in fintech. And they're like, okay, I need the infrastructure to launch this. It's like, well, there are a bunch of different banking as a service platforms. There's a bunch of different like anti-fraud, AML, KYC stuff. I know who I can go to for payments. There's all of this stuff. And then you look at the market for fintech and you say, okay, how big is financial services? Financial services is about 7% of GDP. There are a bunch of huge market cap companies out there, like the top 5 banks, the big insurers. And they have continued. We've done well in fintech. We've got a bunch of companies worth well over $10 billion. Like Stripe is nearly worth $100 billion. Robinhood is trading at kind of a crazy multiple right now, but they're about a $100 billion company. Got Nubank, $50 billion company. But if you look at fintech market penetration, it's still basically 1% of financial services. So in my perspective, we still have a ton of stuff that's worth building. And now we have people who are better positioned to build stuff than ever before. And so you give better people better tools and better infrastructure in a market that's as wide open as it's ever been before, you should expect them to get farther faster. So unlike Ken Lin, who takes 5 years to get to Series A or something like that, you can find folks who can do that in 2 years or less. Fintech's still hard. It's not easy. But if you have like the right ingredients, you can still get there. So that's why I love my job, is that there are all these people who really understand how this ecosystem works. They can find like unique, novel ideas, put those together in a compelling way, and then go out and build something that's different. And that's one of the other things I'm really excited about is a lot of people, some people are like, oh, fintech's dead. There aren't any new interesting ideas. The types of companies I back like couldn't be more different from each other on a day-to-day basis, because financial services pervades all aspects of like how businesses operate. And there's always different opportunities to build different kinds of things. So I think that's basically the answer is, it's still a huge market. We have better talent, better infrastructure. Also, AI makes it way easier to build more stuff from day zero. You don't have to be a pure play AI company, but if you have AI, just basic things like, Cursor for your development environment, not to mention the ability to, say, trivially extract data with complete accuracy from PDFs, which that's like a big thing. Like if you think about it, you're trying to automate mortgage, you're like, I can't get the income out of a pay stub. That was like totally unsolved. And now it's a trivial problem. So there are all these ingredients that mean you can build more product faster. You can build more bundles more quickly. If you look at like the first companies, they're kind of single product companies. A lot of the companies that I back actually have multiple products that are launching from day one. That just wasn't on the table before. So I think we're at a really exciting moment where we're going to see more get built faster within financial services. And yes, AI is a big, big part of that. But it's also because we spent the last 10 years building all these other foundational elements. And, we have better founders, better tools, better fintech specific infrastructure as well. So that's why companies end up graduating to Series A, is like you find those people early, you believe in them, you kind of have differentiated viewpoint as to why they found a real problem, how they're going to solve it, their ability to ship it, their ability to find initial customers. And that's where we kind of end up.
That makes sense. It felt like early days of fintech, there was a lot of vibe of we're going to overthrow the establishment here. We're going to unseat the credit card companies. We're going to beat the big banks. And over time, a lot of that crept towards, well, maybe the next Visa is still Visa, and we're just going to partner with a lot of the incumbents rather than trying to outright beat them. And I know I'm generalizing, and you're closer to this than I am.
Yeah.
But where would you say the mood is today in fintech on, let's say, disrupt versus partner?
So I think you're right on the mood, but I think you're wrong on what's actually happening. So on the mood, I think, fintech now is a broad ecosystem. It's many things. There are people who are trying to challenge the incumbents, but there are also people who are building platforms that are selling into the incumbents. And the incumbents aren't going to disappear in the next 10 years, but I think they are going to start to be fundamentally challenged for market share. And this is kind of a truth that I see and believe, and I think is pretty obvious if you're paying attention, but most people aren't paying attention enough, and this story is very early. And what is that story? That story is that, we're now 10, 15 years into this wave of fintech innovation, and it's really only been in the last 3 years that fintech companies are starting to take market share from incumbents. I think it's funny because incumbents are like, if you go back to it's like the mid 2010s, Jamie Dimon is like, we got to watch out. The fintechs are coming, right? And then kind of nothing happens for almost 10 years. And I feel like, a lot of the incumbents are like, it was scary. Like we thought maybe something, but look, it's been 10 years, nothing has happened. But if you're actually paying attention, people are starting to steal market share from the big banks. One of my favorite ways of telling the story is Robinhood. If you look at Robinhood started out with a product that banks thought was dumb, free trading. They're like, we make money on trading, and not banks so much, although banks often have brokerages that are associated with them, like the TD Ameritrade, the Schwabs, that kind of thing. And they're like, free trading. Well, we don't know how to do free trading because that's like how we make money off of low balance accounts. Also, these are really low balance accounts. Like the first accounts were in $100, $200, $500. They're under monetized. They're making like $10 per user per year. By the way, they're built on top of Apex. So like half of their revenue goes out to an infrastructure provider. And you look at that business in the early days, you're like, cool. It's got like a viral wait list. It's got really high user engagement. But these are small balance accounts that are like under monetized and not making that much money. You fast forward to today, Robinhood now has a match program and they're bringing over 401k and retirement assets. They have Robinhood Gold, which gives you a high yield account and access to a 3% cashback card. The average account transfer in on their match program, I think, is $81,000. So that is very different than a $500 account you don't care about. Basically, millennials have grown up, control more in assets. Also, Robinhood's product stack has matured. And so they are actually starting to take customers that banks really care about. And that really only started happening in the last 2 or 3 years. But it is a one-way street. If you have gotten used to like a streamlined mobile experience for doing your banking or doing your trading or doing your investing, and then you try and log back into like Schwab to place a trade or roll over an account or open a credit card, you're like, oh my God, this is terrible. And so what we're starting to see is people are actually starting to pull in and pull away customers from banks. I like to tell that story because Robinhood is a product everyone's familiar with. It's a product that you kind of know how it works. And like there's something that it maps to in terms of what the incumbents offer. But what I don't think a lot of people realize is that if you look at the B2B world, people are starting to compete with the incumbents completely orthogonally in a way that the incumbents don't even have like any right to win at all. Now, so Visa might still be Visa, but there's a whole other categories and types of financial services where I think the incumbents are just going to realize their customers aren't even showing up today. So let's say you're a small business, right? No matter what type of small business you are today, you probably have a checking account with one of the big 5 banks. You probably have a credit card with one of the big 5 banks, and maybe you have some sort of like loan for the banks. And if you want to get one of those products, there's like nothing that's truly tailored about the business or about how, Wells Fargo conducts their business for one type of small business versus another. The most important thing happening in SMB right now is the rise of vertical SaaS. And that's where you have a single pane of glass, a single operating system that allows you to run your whole business. Like 2 of the canonical examples of companies like this that have been around for a while would be Toast. It's an operating system to run your entire restaurant. It does payment processing. It's your point of sale. They have these automated machines you can go in and type in your order on, but they also do your payroll. They have Toast Capital, so they'll do lending. All of that stuff just sits inside the ecosystem. If you are a restaurant owner, you do not want to have to walk to a bank, open a bank account, talk to a banker, fill out a loan application, go back and forth, wait 3 months. You would much rather just log into your Toast app and hit the button that says, give me capital now. And that capital today is probably more expensive than if you went through all of the pain of actually applying for a loan at the bank's branch. But you're a business owner and your time is incredibly valuable. And so it is much better to have funding faster with a higher degree of certainty than it is to spend like 3 months of pain and brain damage trying to get the cheapest source of capital possible. By the way, as these companies scale, their cost of capital tends to come down over time. So even that cost of capital advantage that banks have is going to start to erode. There's also, I think, a big business model shift where banks' enduring advantage has been their cost of capital and their deposit franchise. Deposit franchise is a fancy way of how banks like to say they're consistently able to screw their customers by not offering them yield. If you look at about the $18 trillion in bank deposits, they pay effectively 0% interest. That means you've got like, $400 or $800 billion worth of kind of free financing that's going in and out and available for them to have low cost of funding to make these loans. SVB collapsed because people realized they actually want yield. And when people start realizing they want yield, banks' deposit franchise, the value of that erodes, the cost of capital goes up, their deposit beta is the lingo of the industry, goes up. And so I think their cost of capital is getting more constrained as customers are less willing to come and spend time going through their products. And I've done a lot of investing in and around vertical SaaS. And there's just all sorts of different categories of vertical SaaS, from like lumber to road paving to, it's just like a golf course, like basically any type of small business you can think of, you can have an operating system for them. And that's going to start to soak away business from the big banks. So vertical SaaS is probably one of the most interesting things that's going to start to happen and just steal customers from banks before they even have an opportunity to get in front of them. I also think, by the way, that one of the big drivers of why vertical SaaS is growing is AI, because you can have products that do a lot of things for a small business. If you're a small business and you're like, man, I would really like help with outreach to my customers, like scheduling coordination, you could probably have like an AI call center agent now that's through your vertical SaaS platform, but you could never have built that yourself. And a bank is certainly not going to offer you. So anyways, vertical SaaS is a great example of how banks are just going to be pushed farther and farther away from the end customer.
Yeah, it's interesting. The deposit beta piece is really interesting, how that sloped upward. I remember Thomas Petterfy on a conference call years ago, used to be an investor in Interactive Brokers, very tech forward firm, to be fair, made a comment that the biggest reasons customers churned were they overextended themselves and IB shut off the account for them. Like,
Yeah.
basically they blew themselves up, or they died, or got divorced or something like that, one of the 3Ds.
Yeah. And Interactive Brokers is popular with like prosumer consumers who are using margin and leverage. To your point,
Yeah.
they can blow themselves up because they're trading on the margin,
Yeah.
which is a little bit different from most of the other brokers out there.
Yeah.
Like
But
the
at the
Schwabs
time,
or
it just
the,
hammered home just how sticky these assets were and customers, and just how loyal or how powerful inertia is. I've had Bank of America base checking account for ages. They pay me so little in interest that they may as well just pay me zero, because it agitates me that there is a stated rate, but it's so low.
It's insulting. If you go into Bank of America, I've been a customer, I'm trying to turn it off because I actually use Mercury Personal as my primary bank account now, but I need to have Bank of America just to do Zelle. So it's just something I push money into. By the way, I can push money into it in real time because you can use same day ACH or RTP. And so I can basically keep that at close to zero and then just push money and then do Zelle. So they don't really have any sort of relationship with me anymore. But yeah, it's insulting because for years I'd look at my like relationship discount. They're like, Rex, you've been a customer for 15 years. You have, a few $100,000 in assets, because I'd had some like retirement assets sitting there for like this great relationship we have together. Instead of paying you 0.01% interest, we'll pay you 0.5. And you're like, that's insane. I'm getting 4.5% everywhere else. And they're like, also, because of our great relationship, we're going to waive our $12 monthly maintenance fee. Like, that's ridiculous. Like, no one charges this anymore. The fact that you like put this in my statement where you show me being charged $12 and then refunded $12 is just asinine. And so, I mean, one of the things that motivates me is like, it's just so frustrating that so little has changed. But people are starting. But that's what I said, right? Like, it's been 15 years and nothing has changed. Like, your personal financial stack has probably not evolved very much. I bet you your personal financial stack is going to start to evolve in the next 2 or 3 years. And once you start moving away from Bank of America, do you think you're ever going to end up moving back to them?
Hard to imagine.
Yeah. So like it's taken way longer than I expected, but it is happening and it's a one-way door.
Do you have a view that you held maybe a few years ago about fintech that you've come around on and you think, I was totally wrong with that?
I mean, here's an easy one. So my very first company that I started working for was called Syndio, Direct Consumer Mortgage Company. Joined them in 2015. I thought mortgage was going to be a huge opportunity. Turned out it wasn't, and that company in particular failed. And the thinking at the time I thought was like really good. You look at Lending Club, they had IPO'd, I think it was 2014, really well received IPO, had gone like up and to the right. If you look at Lending Club post IPO, they've had a little bit more of a tumultuous time. But at the time, really hot company doing really well, doing consumer unsecured credit. Right. So I think credit card debt outstanding was a little under $1 trillion at the time, but like consumer unsecured credit that was non-revolving was a pretty small asset class, but Lending Club was dominating it. It was, sub $100 billion or something. In that sub $100 billion category, really big, successful company. In the public markets. In the private markets, you had SoFi. SoFi was doing student loans. Student loans, I think, hadn't quite crossed $1 trillion in loans outstanding yet, but they were much bigger as a category than consumer unsecured non-revolving credit. They were doing really well. And then you're like, oh, that's nice, but that's a sub $1 trillion outstanding debt. What is way bigger, way more meaningful, and like way more broken? Mortgage. There's over $10 trillion in mortgages outstanding. So it's like, okay, consumer unsecured has happened, student loans has happened, mortgage is going to happen. And in 2014, 15, a bunch of other people had this idea as well that mortgage was going to be one of the next big parts of financial services that was going to be disrupted by startups. And basically, no one has figured out how to make mortgage work. For a while, it looked like Blend had. It looked like, and Blend, by the way, was selling to the incumbents. So the thing that worked was just SaaS fees to incumbents for origination, as opposed to what my company was trying to do, which was to be our own brand, do our own origination, own the end customer, but then also take some risk and other stuff associated with that. It was actually the thing that worked best was just selling to the incumbents or appeared to. But Blend now, and I think this is still the case, is trading for less than they've raised in total. Better was more of a direct comp to what we were doing, and they're actually originating the mortgages for consumers. But they've raised billions of dollars, I think, are now trading at less than that, although they've come back a little bit. So basically, nothing has really worked in mortgage. And if you look at fintech mortgage originations, it's not actually at any sort of meaningful volume. And this is another example of how I think people are like, oh, fintech tried mortgage for 10 years, they failed, like incumbents are safe. And I have the opposite perspective, which is it's probably a bad standalone product. Same with credit cards, actually. If you look at credit cards, a bunch of people have tried to launch standalone credit card products, and it mostly really hasn't worked. But mortgage and credit card can be amazing second products. So like the Robinhood Gold Card, again, we're still pretty early in this story. They have to manage losses. They have to make sure they don't give away too much in rewards. There are all these things, but it has a huge wait list and it is growing very, very, very fast.
People talk about it on X all the time. And
yeah.
I don't see
and
them
they're going to
talking about
figure
their
out how to
credit
make
card.
it work. I think there are going to be some bumps along the way, but they will. But again, it's a one-way road. Once they figure it out, I don't think people are going to go back to the more janky experiences of the incumbents. But mortgage is a huge opportunity. And some of the companies who, like the Robinhoods of the world, have meaningful scaled consumer businesses, mortgage is a very attractive second product. So this is even earlier, but they're going to start to figure out how to bundle that into the core experience. And getting a mortgage still sucks, but AI is going to make a lot of what sucks about getting a mortgage a lot easier. And the companies that are going to figure out how to do that first and best are going to be companies who have tech way more in their DNA, like a Robinhood or like other. I don't want to mention some of the other companies I know who are working on it, but like they're going to be, I think, pretty successful, and it's going to start small, but it's going to be one of those things where like, oh, all of a sudden, these customers you don't care about are customers you very much care about. These lines of business that you thought you had on lock, they're starting to migrate out of the incumbents. So that's going to be an interesting thing to watch next. So I was wrong for about 10 years that like mortgage would work. I think it is going to start to work. I think it's still an open question whether you could start a purely mortgage focused fintech company where you're the brand, you own the customer relationship. Maybe there's some opportunities for building infrastructure. There are people doing things in and around servicing. There's still folks who are working on like embedded mortgage products. But whether you can build like the next rocket, I'm not as sure about that right now. Although I'd love to have people come and pitch me and tell me why they think they actually could do that. But I do think it is going to start working as a second act.
I mean, to be fair to mortgage, is part of that just that it's been a horrible market after we got out of ZIRP and mortgage demand has been really low? I mean, has that been part of the problem?
Yeah, so there's so many problems with why it's hard to start a mortgage company. One is you have to build a brand. A priori, no consumers are going to know that you exist. And most consumers, when they get a mortgage, they go to their realtor or their existing bank. So where in that customer journey are they going to discover you? And the answer is, for most consumers, they will not discover that you, this cool new Silicon Valley startup that's going to disrupt mortgage and is way more customer-centric, they will not even realize that you exist. Your one thing that you maybe can do is compete on price, right? You want to compete on customer experience and you want to get like organic growth, but a priori, someone shopping for a mortgage does not know the extent to which you have a better customer experience when you're a new company and do not have a lot of customers. So then you might be able to acquire some folks through rate tables, but now you're competing on price, and those leads are often getting, you're getting them through LendingTree or somewhere else. They're getting called by 10 other banks. And so you're in this like fight for acquisition. CAC basically is the reason why it's really, really hard. Let's say you solve the CAC problem. You have like a unique go-to-market. You figured out something that's like really scalable, allows you to acquire users at lower costs. You've like started to build a brand. Oh, well, now you have another problem, which is the one you talked about, which is the cyclicality of the industry. I've used to know all these numbers in terms of how many mortgages there are outstanding, et cetera. And on average, about 1/7 of all mortgages change hands every year. But that can go from 1/7 to way under 1/7 when rates go up because way fewer people are refining, or it can be more than 1/7 when rates are low. And so you could be hitting this refi boom and you're like, business is growing, you're scaling loan officers, and then all of a sudden the refi boom dies. And so the transactional and the like cyclical nature of the business makes it really, really hard to maintain this kind of steady growth rate that investors want to see. Because it's a transactional revenue business versus a recurring revenue business for the most part. And so that's another really, really hard piece. And then it turns out, I think for the last 10 years, it was really hard to actually automate the back end because we didn't have AI. It was really hard to, pull the income off of a pay stub in addition to about 20 other little things that you would have to do as part of the loan closing process. I think that is now being solved, but we still have these other two big problems, which is why I feel very sure that mortgages as a second act product are going to start to be a thing. And maybe there's some people who are going to figure it out as like a first act primary focus, but it's still hard to do that.
Maybe to take it back to your fund and the investing side, how do you think about portfolio construction? And part of the reason it interests me is someone who has a little more general tastes. It's a lot easier for me to get diversification with a fewer number of names. How do you think about that within the context of having a fintech focused strategy?
Yeah, I love being with founders at the earliest level of their company journey. I love doing that because that's where, the folks I back are very well networked and they understand how a lot of stuff works. So I don't want to like oversell my ability to help them because most of what I'm trying to find is really capable people who actually need very, very little help. But I spend all of my time talking to people in the ecosystem. And so I can often find things that are relevant to the founders I've backed, even when they have their own incredible networks that they might not be aware of. And I can help them find, first customers a bit earlier. I can help them find channel partners. I can get them talking to the right person at the right partner bank so that they can open, accounts for their users faster. And then one area can really be helpful is, and this is probably my primary job as a pre-seed and seed-focused investor, is help them get to Series A. A lot of that comes down to them building a great business. But there's also this whole piece of they have not spent the last, 10 years building relationships with hundreds of other investors, which I have. And I know which investors are interested in which categories, actually are actively deploying. And so what I can do is when you go out, if I am back at the pre-seed, when you go out for the seed, I can put together very quickly a list of 50 folks. We can winnow it down from there to your top 10, depending on exactly what you look for, and get you in front of the right people in the right time. Again, you could probably find these investors on your own, but it's way easier if that takes, 3 hours after like we have an initial call, I put the list together, I send it to you, than it taking you 2 months of like being like, oh, I'd like to talk to this firm. And I'm like, well, actually that person you want to talk to at that firm, they've left that firm or they're about to leave that firm or they actually aren't really doing fintech anymore. And so you could even know the firms but not even know the right people. So helping them get to Series A, I try and leverage my network in a bunch of ways to do that. But like the cleanest and easiest way that often manifests itself is just helping them get their next rounds done.
Are the yardsticks for Series A as painful as they sound right now?
So I guess let's just do like a quick market overview on Series A's. One is that Series A's are actually close to all-time highs. A little bit of that is probably inflation, but if you look at the Carta data, the median price for Series A is actually close to record highs. Two, graduation rates have gone down for when companies were 3 years old. So like call it companies founded in 2018, but were raising their A in like 2021. And maybe they were like 30% if you look at the Carta data for like 2 years from pre-seed to seed. But now they're just closer to historical norms of being around 15% from seed to Series A in about 2 years. So the Series A market is mostly what it's looked like in, the last average over 10 years or so. And then there's the next question of like, what metrics do you need to hit a Series A? And that can vary a lot. A lot of times you'll see revenue targets, but it's not just revenue. The thing that always gets excluded from there is growth. If you've gone from 0 to 1 million and it's taken you 2 years since you launched your initial product, or especially if it's taken 3 years, it's going to be very, very hard to get anyone interested. Even if you've gone from 0 to 2 million, but you only grew 2x year over year, it's very, very hard. Really what investors are looking for is you've hit at least $1 million in revenue and are growing 4x plus. So you need the revenue and you need the growth. If you're in like an interesting category with a great team, it could be sub $1 million revenue, but that's basically someone who's just convicted on the team in the category. That is a terrible way to like design a raise process. Like I would never advise any of my founders to go out and raise in advance of hitting at least $1 million in revenue. But every now and then they do raise rounds in advance of $1 million in revenue because they're really a high caliber founder. They're making good, quick momentum and having some great wins with early customers, but they just haven't gotten to the revenue target. And then the other thing that I love telling founders to do is just wait, because there's never been a better time to build a really capital efficient company because you can use AI to hire fewer engineers. Also, I have a lot of teams that use offshore engineering resources. That's a terrible idea if you've never done it before. If you've done it for 10 years across 3 companies and you know that these are some of the best engineers you've ever worked for, that can be an amazing cost advantage and give you a ton of product velocity. So if you're able to be capital efficient, you can wait and you can raise later. And as someone who's investing very, very early, I like that because one of the things I worry most about is like, I might have some really successful companies that have a ton of dilution. And for the founders, that's also hard for them, right? You can get stuck in a hard place if you're a quote $1 billion company, but you've got $300 million that you've raised that's in the pref stack, and your company is now worth half as much as it was. And you have a strategic acquisition offer that's in like hundreds of millions that would have been life-changing equity had you only not done the last round. So anyways, there's like some interesting things in terms of, just thinking about being capital efficient now that are a little bit different than they used to be not that long ago.
How do you approach reserves and follow-ons?
I mostly don't do reserves because I like to focus on pre-seed and seed. This is getting into, I don't know how much of your audience is more like the VC LP audience versus the founder audience. So this is more of a consideration for other VCs and LPs. I guess for the founders, the one thing you should know is you should know what the reserve strategy of all of your investors is, because if you raise, $1 or $2 million pre-seed round, you want to know if the investors that have given you that money actually have twice as much money that they're expecting to invest later and maybe could invest in a bridge or lead a subsequent round. Like that's just something you should know. And you should just ask them like, what is your reserve ratio? And like, do you expect to participate in future rounds? Because it'll give you a sense of like your insiders, how much capital they can bring in the company. I mostly though don't have reserves. And so this part of the conversation is more for other VCs and LPs. I'm very fortunate that I have a very high Series A graduation rate. And if you're investing at a low price, but then in a short period of time, it goes to a high price with a high degree of consistency, you just get less ownership for a lot higher dollars. So I think the math is pretty simple on fund construction that if you're doing pre-seed and seed, you're saying, I'm good at finding good companies early. Well, if you're really good at that, then you should probably buy more ownership early as opposed to waiting and paying more later. I think you could argue that would be wrong if you say, well, once they get to Series A, I know which one of those companies is the best company. But if you have a really high Series A graduation rate, the end that you have to choose from is actually pretty high, right? If you have a low graduation rate and it's 10% and you have 30 companies and there are only 3, it's like, okay, you have to pick one of 3. But if you invest in 30 companies and 15 of them make it to Series A, and now it's like, which ones are the best one at the Series A? You talk to any seed investor who's been around for a long time, and they will tell you it is really, really hard to know because the world is full of randomness that happens. People are working very hard. It could be a mortgage company that's growing incredibly well today, but it's on backs of refi volumes. And then, the pandemic ends, rates go up, and all of a sudden their whole business goes away. That's crazy. Or it could be a company that continues to grow a ton, but they raise a lot of money and you end up being so diluted that you were right. They were the biggest outcome, but it was actually the worst place to put your money. Or you could have a company that has like a subscale outcome, like they sell for $500 million, but they never raised a Series A because they got to profitability after their first round of funding. And so there are all of these confounding variables that I think make it really, really hard for people to be super intellectually honest about how they're going to be the best at picking some of those folks if they're allocating later at much higher prices.
I think they're good points. Matt Conwell was on the show from Rare Breed once, and he made a really interesting point, which was there's also bias towards doing follow-on for your first companies that are doing the next round out of that fund. So if you're one of the companies that was invested in year 1 versus year 3, you're actually coming back for rounds sooner rather than later. And it may turn out that the best company you funded was in year 3. You don't have any follow-on left at that point. You miss out on that, but you did the ones that came before.
Yeah.
So there's just some randomness to that, which doesn't help.
Yeah, the timing of stuff is, and part of that kind of makes sense, right? If we're reserving for a follow-on in a company that you did at the end of your active investment period, well, the follow-on opportunity, and that was 3 years, and the follow-on opportunity comes 3 years later, that would be year 6. Whereas if one of your first companies, there's a good follow-on opportunity, and you invested in day 0, and now it's year 3, that kind of makes sense and aligns with the fund's life cycle, whereas the other one does. So there are like all these issues that I think make reserves hard. I'm not saying no one can do it. I think simply that a lot of people falsely predict their ability to be able to do it very, very well.
What's a question you love to ask founders?
I'm not trying to ask questions of founders. What I want to do is, I show up with a prepared mind to a lot of conversations, spend a lot of time in fintech. I just want them to teach me something that's interesting, I didn't know before, and that is tied to like a really interesting opportunity. So really what I'm trying to talk to them about is like, what's your story? What are you building? Like, what from your story is why you like have this insight that is unique and timely and compelling? And so I'm just trying to figure out like what it is that they know. Like some people will refer to this as like having an earned secret. So it's like, what is the earned secret that they have that relates to the opportunity that they're pursuing? And so a lot of my questions are trying to understand their story, what they've learned, and then when they kind of talk about the opportunity, digging into why they know things that other folks don't. Also, by the way, sometimes it might not be that they know anything that anyone else doesn't. It's that they have better relationships because for better or for worse, a lot of financial services are heavily permissioned. And sometimes there are things that like a lot of people want to build, but it's very, very hard to get a partner who will let you build that thing, right? For example, I'm not saying starting a new bank with your own charter would be a good idea, but getting a de novo charter from the OCC, very hard, very few de novo charters. So like starting a bank is a very, very hard thing because the partner, the regulator, just like isn't doing that anymore. But even if you're a company that wants to launch a credit card or a debit card, you have to find someone who's going to be your BIN sponsor, who's going to provide the current account, all that sort of stuff. And that could be, if you're a kid in your college dorm room, very, very hard to get people to make that bet on you, which in many ways I think is very frustrating. Like I wish it were a more permissionless space to go and innovate in. But the unfortunate reality is there are all these permissioned layers within fintech.
What's a conventional view in venture you think is BS?
One of the things I love about venture is that it is a ecosystem that exchanges a lot of information at high velocity. And so in that velocity, sometimes ideas get popular that end up being wrong, but the ecosystem usually metabolizes those ideas pretty quickly. Also, I think some of the things people get frustrated about are like momentum chasing and hype and lack of substance, but it's actually underlying kind of set of incentives behind the asset class. And so it's not that I think people are getting this wrong. I think it's that there are certain incentives in the asset class that drive towards hurting. And a lot of people in venture will tell you this. And part of it is just because of how slow the LP ecosystem is to react to changes on the ground. Like the feedback cycle between an LP and the venture ecosystem, just if you look at, when they actually get their money back, that's like 8, 9, 10, 12 years, right? So like, did that investment work out? Well, on paper, it looks good. Oh, 9 years later, it worked out. Oh, great, it worked out. So this firm that started like 12 years ago, and I'm in their like funds 1 through 3, I guess I'll put more money into their fund 4, even though that fund 4 is 5 times bigger, focused on different sectors and like whatever. But I've been at this endowment for 4 years. We have these 10 relationships. I'm going to be gone in 10 years. I could stick out my neck and say we shouldn't do this re-up, and instead we should go after this new manager who doesn't have a brand, but I'm going to have to fight my committee. And then it probably won't happen anyways. And I'm going to be gone in 2 years. And if it worked out, I wouldn't know for 10 years. So let's just buy into the thing that we're already doing. Right? That's like a stylized, oversimplified idea of how like an individual might act. But there's some truth to the fact that the LP ecosystem is incredibly slow to adopt to changes on the ground, which is one of the reasons why you see the large firms continue to get larger. And it's not that I don't think there actually should be a few really, really large firms. If you look at accounting, you look at banking, you look at consulting, you'll see the same effect that has played out over 30 years where you go from a highly fragmented industry to, a more consolidated. In banking, you have the big 5. In accounting, you have the big 4. In consulting, depending on how you frame it, you have, the big 3 or something like that. And so I think it is a natural progression of fragmentation, but there are also some just interesting currents in terms of how slow the LP ecosystem is to react.
Awesome. Well, Rex, this is really fun. I appreciate it. Thanks for coming on the show.
Thanks for having me, Joe. Appreciate you letting me talk your ear off about fintech.
Thanks for listening to the show. We really appreciate the support and would love it if you'd subscribe to the podcast on iTunes, Spotify, your preferred podcast platform. One more thing. Investing in startups is not of sponsors, but I want to give a shout out to one of our portfolio companies, Micro One. Micro One helps businesses ranging from startups to enterprises to source world-class software engineers. Micro One uses their own AI tools to identify top 1% engineers and get them working for customers in as little as 48 hours. And if Micro One could help one of the largest AI companies in Silicon Valley hire 250 engineers in 30 days, they can probably help you too. If you'd like to learn more, visit microone.ai, and thanks for listening.
Joe Mager is the founder and managing partner of Cambrian Ventures. The content here is for informational purposes only and should not be construed as investment, legal, or tax advice. The opinions expressed by guests are their own and do not reflect the views of Cambrian Ventures. Our host, guests, and clients may hold investments discussed in this podcast. Please invest responsibly.